From Washington, this is the Macrocast, a podcast brought to you by Penta and Markets Policy Partners.
Good morning. You're listening to the Macrocast. I'm Meghan Pennington, Managing Director at Penta, and joined as always by John Fagan and Brendan Walsh from Markets Policy Partners. Hi, guys. It's been a while since I've been here to host. It's wonderful to see you again. And
so great to have you back.
Thank you. I appreciate you having me back. And on a day when we have such a full slate of smart folks to join us. So this week, we're welcomed by our monthly guest, John Dick, CEO and founder of Civic Science. He's back on to help us break down the latest economic sentiment index. John, great to see you as always.
Great to be back as always. Happy belated New Year.
Thank you. And two other exciting folks today. First, Bob Dohner, a former Treasury official and now a senior fellow at Atlantic Council. Bob is a renowned expert on Asian economies, including China. Bob, we're so excited for you to join us today and look forward to hearing you break down some of what's happening over there in that tremendous economy.
Well, thank you for inviting me back on the podcast.
Absolutely. And then finally, I'm so thrilled to say hello and welcome to one of my Penta colleagues, Matthew Robbins. He's a senior associate at Penta and our resident China expert. So Matthew, usually Matthew and I are working on client things together. It's so fun to get to do, an economic conversation today.
Yeah, thank you so much for having me on.
Absolutely. Well, welcome to the Macrocast, everyone. Let's kick things off with this week's Economic Sentiment Index. John, do you want to give us a readout and kind of tell us what you're seeing there?
Yeah. I guess if there's the bad news, such as it was the first down reading we've seen actually since kind of early October. Now that said, it was like 0.3 points of a decline, and that was really after kind of two pretty consistently flat readings. So I think there's just sort of like a tenuousness right now with the consumer is what we're seeing. That dip isn't necessarily anything to be, overly alarmed about. It just, it's the same story we've been telling for a year and a half. It's just, there's this really kind of mixed cocktail of consumer sentiment, depending on what perspective you're looking at it from. Confidence in the job market kind of fell the most since the beginning of the year. And I think it's just, I don't know how much that's the consumers really feeling that, or if they just can't ignore the headlines, right? Of, massive layoffs, and just another one this morning from Google and, or Alphabet, as it were. And, some confidence in spending, particularly major purchases, fell a little bit since the holidays. That we see that almost every year as people get on the backside of Christmas and those credit card bills show up, and we start to feel the pain of a little bit higher heating costs and things. Probably the rosiest number there is what we saw sort of an economic outlook. So the consumer's more optimistic about where the economy's going. And I think they're feeling maybe like we've sort of bottomed out from an inflationary standpoint, and the most recent inflation numbers were pretty positive, such that the consumer sees those. Although it's not even just about them seeing them. The consumers shown themselves to be remarkably sensitive to inflation. When we ask them how concerned they are, and we track that with actual inflation numbers, they're remarkably sensitive to that in real life. So no, it's kind of a mix, but nothing like overly alarming or overly positive. We're just sort of in stasis for now.
Yeah, the jobs or the jobs outlook is interesting to me, because I was thinking that just this morning, of course, with the we had Microsoft this week, and then we saw Alphabet this morning, but then comparing that with jobs numbers last week, it does feel like there's a little bit of kind of like the news cycle driving some of that sentiment. Is that what you think? Too?
Yeah, I mean, very much. I've heard it referred to as a Patagonia vest recession, right? Where we're seeing, the jobs kind of coming from a particular sector of the economy, but sort of, other non-farm payroll jobs are holding up pretty well. I mean, certainly like in the services industry, there's still a shortage of workers. So again, it's just kind of like conflicting forces sort of back and forth. We are seeing the consumer also cutting back in some spending right now, particularly in the grocery category. That's a place where people are trading down in a lot of areas. 80% of consumers say that they've chosen not to purchase a product at the grocery store at least once, if not more times, because of a higher price they're seeing. Eggs, of course, are getting all the headlines right now. But yeah, I mean, as far as the job market goes, there's definitely some sense that the big headlines are driving a little bit more of the cautiousness with the worker than the actual reality of the market.
Okay, I have to take a moment. We have to talk about the egg memes. I can't get enough of them. They crack me up. I think the favorite one that I saw yesterday was a guy who had taped an egg to his wrist and was holding it in front of his Porsche steering wheel as though he were showing off his luxurious watch. I don't know if you guys have a favorite. That one really got me.
I more than the memes, I like the fact that you just blew right past that egg pun, that eggs memes crack you up.
Oh my gosh. See, guys, I'm a comedian and I didn't even know it. It just comes out. Gosh.
My favorite is that we were so wealthy back in the 90s that we would take toilet paper and eggs and throw them at the houses of our enemies.
Oh man. Yeah, I really, the egg memes are pretty good. They're giving a laugh, but it's kind of a crazy thing, right? I mean, I wonder, in cities where you have, a big selection for where you can go for your groceries, you can go to Whole Foods, you can go to Safeway. I wonder if even among that Patagonia vest that you see folks saying like, okay, this week I'm going to stop into the Safeway instead of the Whole Foods.
Yeah, I mean, that's all over consumer spending right now, not just eggs, but people definitely trading down, and moving from retailer A to retailer B, or from blue chip brand A to private label brand B, which in many ways for the long run is pretty good for retailers because they want to push those private brands. And what we've seen is, and we've seen this throughout sort of the post-COVID economy, is that sort of this notion of, brand loyalty that marketers love to talk about was always a bit of an urban legend. Our loyalty goes only so far as availability. And when, supply chains, when shelves were empty, people quickly switched from that brand they bought forever to a private label, which tended to be better stocked in the stores. And that's going to have a long-term effect, because I think what consumers are finding is that there are good, equivalent, if not better alternatives you can get at a lower price. And that you don't put that genie back in the bottle. And then, of course, you've got, the internet's a deflationary tool. So people are able to price shop better. They're able to, there's a lot of different, and again, those are teaching new habits to the consumer. So we suspect that this will be permanent. If there's a, optimistic silver lining to that, you'd think that reduced spending is going to help kind of accelerate the decline of the slowing of inflation, excuse me. So we'll see how that plays out. But at least right now, coming straight out of the holidays, with the credit card bills landing and so on. I mean, the consumer was remarkably resilient through the holiday retail season. It slowed a bit in December, but the retail industry, and then the economists who track this, it's getting harder and harder to measure because people started buying holiday gifts in June. We've never had such a the holiday shopping season is now so protracted. First of all, it's almost going to be hard to measure, because what did I buy in June that was actually a holiday gift? But when we try to evaluate, like quote unquote holiday retail spending, it's not as condensed as it once was. And I think maybe that petered out a little bit in December, but that's maybe just because everyone had already bought the stuff that they were going to buy by then. Yeah.
It strikes me that also some of the, when there's pressure to save, I think some of consumers, feel good, or some of the filters that they put on products that they will buy. So even, and when people are less worried about price, like in cosmetics, for example, packaging is a big deal. ESG concerns, waste, zero waste kind of stuff, that those products are usually more expensive. I wonder if we're seeing consumers kind of step away a little bit from their values-based shopping and going for things that are more affordable because it makes them feel safer in this moment.
Yes, no question. I advise our clients about this all the time, particularly in the last several months, that when household budgets are tight, you don't have the intrinsic reasons to buy things become less important. It's sort of, I look for the thing I can best afford. Now, that's not to say we tell those leaders, that's not to say you should change your strategy about ESG, because if you're only doing it to make more money, shame on you, right? Like that doesn't detract the other reasons to do it. But absolutely. Now, look, 73% of consumers say that they at least somewhat consider those kind of social consciousness and value factors in shopping. So it's still a large percentage, and 27% say that it's very important. Now, those people tend to be in higher income brackets, of course, so that's going to affect more aspirational to luxury goods more so than, say maybe the grocery channel or what have you. But yeah, I mean, we've definitely seen household economic headwinds sort of dampen a bit of that intrinsic based shopping a bit. It's certainly really far from where we saw it in like the summer of 2020 during that sort of peak sort of George Floyd crisis. People really sort of leaned into social based shopping, and we've kind of come back to where we were sort of pre 2020. But like I said, I mean, that's not a reason that a retailer or a CEO should reconsider that stuff. But yeah, it definitely matters a bit more right now.
No, I have to imagine that it's these are kind of like the little blips and volatility or of choice over in times of stress. But I think the idea, of course, is over time, standards will raise across the board, and then everything becomes a little bit more affordable to do. John and Brendan, what are you seeing any echo of this? The consumer sentiment and in the markets. Are anything notable that we should be looking at there from the kind of the macro picture?
Well, this week we got a pretty lousy retail sales data point, and Brendan can speak a little bit more about the specifics. But the markets are in this kind of this transition period, right? And worries about inflation have largely left the stage to be replaced by concerns about recession. And the Fed's response function here is a big delta in just how scared investors and market participants are about the severity of the recession that they believe is coming. It's consensus that there's going to be some kind of economic contraction in the U.S. this year, but that's not there's a lot of uncertainty. And so we've seen at the beginning of January here markets try to talk themselves into a soft landing, but the retail sales data this week was a counter argument to that, and the markets paid the price a little bit here. Yeah,
and prior bad data, the market actually took it kind of well. The equity market, the bond market has been kind of ahead of the curve on the Fed for a while. But equities viewed, okay, the data is starting to slow, so that's going to cause the Fed to pull back from their aggressive tightening. But this week, that narrative was a little different. The market reacted to bad data. The equity market sold off on bad data. So I think, for the next few weeks, we have corporate earnings, so that'll probably be a little more important than the data coming out for the next few weeks, which isn't massively market moving, other than on Friday, we do get the Fed's preferred price measurement, the core PCE price index. But we kind of already know what that is from the PPI and CPI. So we'll see, how. So the big banks have reported, and for the most part, they did fine. Investment banking was down, but we're not seeing a huge increase in default rates on most core lending. However, Discover, which is a little more on that middle class, especially the middle class of America, they did warn that the charge-off rates are going to start to go up. So we're starting to see some cracks in the economy. Commercial real estate is also weak, but that's something we've known about. People don't go to work anymore, so it's not a shock that commercial real estate is having a little bit of a hard time.
Guys, this is where I turn into a listener. We watch the consumer, right? That's what we study, and we certainly watched them very closely since long before, but particularly since March of 2020. Were the markets just like oblivious to the fact that the numbers for the last year and a half were just irrationally good? I mean, these like spending numbers we see in retail, like if you had drawn a straight line from 2019 to 2022, it would look incredibly rational, right? But we had this very irrational surge in the middle of that. We're kind of punishing the market over sort of unreasonable comps? Was it just that they couldn't resist the temptation of thinking that was a new normal? Or
the market can be irrational over long periods of time, but rationality goes out the window when you have such massive liquidity. And 2021 was just an example of that. We threw like $5 trillion at people. And to the equity market. Yeah.
To your point, John, we got an earnings report from Netflix last evening. They had more subscribers than expected, so the stock jumped in the pre-market and took it back to essentially where it was at the outset of 2020.
Yeah, exactly.
It was like an incredible stomach churning round trip from like 150, like $300,
no, but I think
700 to 150 back to 300. Yeah. And just as you say, like markets are supposed to be efficient and prescient and, discounting what goes ahead. But yeah, as Brendan said, under the.
But I think, John, your point is really important, and especially when we look at the economy and where we are and where we came from, because, the stock market was down 30, percent less than the NASDAQ and 20% for that. For the S&P. So you have a lot of, talking heads saying, we're going into this great global recession, the stock market's going to plunge another 80%. But you have to remember, it went up 33% in 2021 on nothing. So we're kind of course corrected and we're back where we started. Now the question is, are we going to recession? Can the economy stand it? Or are we through the worst of it? Inflation's going to kind of moderate. The Fed can also moderate. And then we, not necessarily muddle along, but we just kind of move forward, but at more normal growth rates than what we experienced, because of the COVID situation.
I mean, I certainly think that's what the consumer feels. For what it's worth, right? Now, the problem or question is
most consumers still have their jobs. I mean, the unemployment rate still is 3.5%. So why wouldn't they?
But then this gets back to like, do the markets and the news cycles talk the consumer out of that optimism? Like, exactly. no, it's not that good, right? Like, no, look at this. When it bleeds, it leads headline, right? And they're like,
and man. You do see that. I mean, it in the surveys where. How's the economy bad? How's your situation? Oh, awesome. Yeah.
Guys, this is great. Let's take a short break and then come back and get Bob and Matthew into the conversation and talk about China. Everyone, you're listening to the Macrocast. We'll be right back.
Every 2 weeks, Penta measures U.S. adults' feelings and expectations toward the economy. The Civic Science Economic Sentiment Index, powered by Penta, accurately measures movements in overall national economic sentiment and provides a more sophisticated alternative to existing economic sentiment indices. To learn more, contact us at pentagroup.co.
And we're back with the Macrocast. So Bob, tell us what's going on in China. We think that this next year is expected to see higher growth there, and maybe this like a rapid transition away from zero COVID policy. Talk to us about what you're seeing and what we should be paying attention to in the news coming out of China.
Well, Megan, I think that's right. I have some good news from China. Growth this year is going to be significantly higher than expected. It'll be over 5%, quite possibly 5.5% or more. In fact, it's possible that China will contribute half of global growth in 2023. There are two reasons for this. The first is an incredibly rapid transition from zero COVID. It's going to have huge human costs, but the adjustment the exit will be over this month or next. The second reason is a shift in official policy towards boosting growth. This was clear in the December Central Economic Work Committee report. It's also an effort to rehabilitate President Xi's kind of battered reputation from the zero COVID and zero COVID exit experience. But the change in the official policy is a very powerful signal, not only to the government, but also to private entities and private investors. There'll be the key drivers for Chinese growth will be first consumption. We'll see a jump of consumption after 3 years of suppressed household savings. In fact, if they get back to a normal year, normally contribute 4 percentage points to Chinese growth. And there's a lot of excess savings that Chinese households can draw on at this point. The second driver will be efforts to stabilize the property sector, which was a huge drag on growth last year. It may have subtracted 2 percentage points from growth in 2022. It's likely through policy measures the Chinese government will be able to reduce, if not completely eliminate, the drag on growth from the property sector. And in addition, there'll be some boost from increased investment, infrastructure investment. And these three, consumption, property stabilization, some increased investment, should be enough to overcome the fall in net exports that's going to take place this year. Now, I should emphasize that the change in official policy is a tactical measure. It's not an ideological measure on the part of the Chinese government. I don't think the orientation of President Xi or the government has changed, but this is a growth year. And China will deal with longer-term structural growth, demographic problems in the future.
I find it's an interesting juxtaposition between, we were just talking about, American consumers and feeling like they have to restrict a little bit now. And China, you're describing after this period of lockdown, you're not participating in the economy, the notion of extra savings. I mean, like money to burn a little bit. I wonder, what we think that's going to do. I mean, obviously it'll contribute to growth in a way that it hasn't been while this, zero COVID policy has been enforced. But I wonder on that consumer level, if we're going to see interesting things on purchasing, from groceries to, luxury goods. If we're imagining probably not so much to the luxury scale, but, just maybe, people are ready to go out and kind of start having a little bit of fun again, kind of experience life in a way they haven't for a while.
Well, that's certainly true. You'll see it in services, and you're already seeing increased mobility. The government is estimating that there'll be 2.1 billion trips over the Lunar New Year holiday as families or individuals return to their families. Actually, you will see it in luxury goods. The excess savings probably most concentrated in high-income households, urban households, and it's luxury goods that have seen the biggest drops in the past 3 years. It's hard to estimate excess savings, but the propensity to consume, the savings rate has increased by about 4 percentage points from where it was prior to the pandemic. And estimates are about 5 trillion yuan or 10% of retail sales in excess savings.
Well, China is certainly a tremendous market for for luxury goods. I mean, I think we know that is, we have a lot of buyers there from, love the Louis Vuitton, Gucci handbags. I too love those things. So maybe that's why I pay attention to that coverage in the news. But Brendan, go ahead, jump in. I think you're going to ask Bob a question.
Why did the leadership just do such an abrupt 180? I know it was around the World Cup, but I haven't heard of a great explanation why they just said, "Okay, go for it."
I think a couple reasons. First, the costs of the zero COVID policy and the more frequent lockdowns were really accelerating in the fourth quarter. Yeah. And in addition, there was evidence that it just wasn't working. There were outbreaks in a number of additional cities. Plus, the economic costs were turning out to be quite high. You began to see public protests, quite widespread public protests over the zero COVID policy. And you actually had warnings from major industrialists like the president of Foxconn saying that the zero COVID policy was going to have a very large impact on Chinese exports. So the cost benefit consideration, I think, just altered sharply towards the end of the year.
Matthew, tell us, what are you paying attention to in news out of China?
The first thing that I'm looking at, I completely agree with Bob's comments. Just if you're looking at recent statements, even just seeing Vice Premier Liu He at the World Economic Forum recently, just sort of his China, him talking about China being back in business, just being back, even that shift in language from leadership is important to note. What I'm also looking at, just talking about the luxury goods point, is I'm looking at shipping rates right now, and what you're seeing is Baltic Dry is increasingly hitting. Baltic Dry measures the freight rates of dry bulk goods. You're seeing that hitting new lows. You're also seeing the cost of freight containers going from China to the West Coast hitting lower levels. Now, it will be interesting to see, are we going to get a flare-up of the supply chain disruptions again, as we did in the U.S. when there's an increasing demand spike in China? That's something I'd love to hear Bob's opinions on. But currently what you're seeing especially is that normalization towards pre-pandemic. We are back in business, that we are going to continue that normalization towards trade and bias towards business.
So my sense is that the China supply chain disruptions have largely been associated with COVID and with lockdowns. And those may take place this month and maybe early next month, but I think will largely disappear after they've gone through the big surge and fall off of COVID infections. I don't think demand shocks are going to translate into supply chain disruptions in China.
How about Secretary Yellen? Had a meeting with the Chinese, and apparently she's going to go over and visit it. It seems like China is also maybe lessening their tone towards the West. What do you think about this?
Well, that's definitely true. I think it's part of a policy of risk mitigation on the part of the Chinese government. Yeah. Part of the orientation towards growth. And I think part of an increasingly effective policy on the part of the Biden administration to isolate China on high technology issues and to impose what's beginning to look like a blockade on advanced semiconductors and supercomputing chips.
And do you see that continuing here in the United States, no matter what China does?
Oh, definitely. I think those who've worked in government, John will know this. There are certain orientations or approach to issues that gain momentum. It's like a watershed, and they begin to flow downhill. And I think the national security approach to China, the national security interest in dealing with China as a pure military and technological competitor is quite strong and probably irreversible.
Yeah, I'll let John speak to it, but he said, you were there too, because Trump kind of got it started. And then during the election, there was kind of talk, the Democrats are going to be weak on China. And I think that completely changed, 3-4 years ago. And there's no doves on China anymore. And he was saying that, in the Treasury, there literally wasn't anybody left on, free trade is going to change, the politics in China. And there's just a consensus view on how we have to deal with them.
No, I think that's right. I think it actually goes back to the last couple of years of the Obama administration.
Interesting.
When there was a real darkening of views on China. And continued through the Trump administration. Ironically, the one person who wasn't completely on board was President Trump, who was quite eager to sign a deal with the Chinese. But under all of this, there was a gradual, continuous strengthening of the positions of the national security folks, Defense Department, National Security Council, over the more free traders, global economic growth folks, Treasury, most of Commerce, and much of the State Department. And that's definitely continued in the Biden administration.
So, guys, I want to shift eastward just a little bit to talk about the news coming out of Japan. I think we saw this week, the Bank of Japan making no changes to their yield curve range. What does that mean for the Japanese yen?
Well, the Japanese yen had a virulent reaction to it in the very short term. It had a spike drop almost 3% against the dollar, but came back relatively quickly. It's bleeding out again today. We got an inflation number that was relatively, I think, the highest since 1981 on a headline basis. And juxtaposed to that was Governor Kuroda, Bank of Japan, Governor Kuroda's comments from Davos, where he was still very much focused on the expectation that inflation would be below their target by perhaps as early as the end of this year. And he had demonstrated on Wednesday this redoubling of the ultra accommodative stance, not continuing to previously they'd done a concession to the markets, so to speak, and widened their yield curve control band from 25 basis points to 50 basis points on either side of their 0% target for the 10-year Japanese government bond yield. Sorry about the long discourse. And this was taken as a sign that they were in full retreat, perhaps. And the next move would be further loosening of yield curve control and rate hikes, even in the back half of this year, as Governor Kuroda's term is done in April. But Kuroda has had a penchant throughout his tenure to surprise the markets. He did it again this week. And, at least so far, the response from markets has been, weakness in the Japanese yen, but not precipitous and disorderly weakness, a dutiful and well-behaved 10-year Japanese government bond yield, and equities in Japan up. So, if we do end up going into a recession and a global recession later this year, the Japanese monetary policy is going to look, its perception is going to go from out of step and overly accommodative to actually, prescient, forward-looking, and appropriate, potentially.
So what do we need to keep our eyes on? Just kind of see, what happens over the next few weeks and months?
Well, one of the big shifts will be who is Governor Kuroda's successor. And that's really going to be the tell, I think, that markets respond to most specifically. And that who that person is still up in the air.
Interesting. All right, guys. Well, I guess should we wrap it up with just it'd be difficult not to touch on the debt limit craziness that we're hearing here in domestic news. John, I tell us what you think. What are you nervous? Do you think this is is this roiling the markets, or is this more of a political story right now?
I think it's still it's ever since the initial 2011 episode that really did have a significant market impact. That was a showdown that it just was very dramatic. It resulted in a downgrade by S&P and so forth. So, but since then, we've just seen the sequel of this battle time and time again, and it's always ended the same way, with an 11th hour accommodation, some way, shape, or form. And so, whether the expectation is correct or not, markets are, have a tendency to, assume the boy that cried wolf posture, which is, we've seen this movie before. We know we can't overreact to it. So you end up seeing, some kinks in the bill yields that are around the date, that people are fingering the wind for, the real end of the road for the Treasury's extraordinary measures. But, that's a moving target. And it's really hard to orient just generally speaking, it's really hard to orient your investment strategy around an extremely low probability but high risk event of uncertain timing. So markets tend to just blow it off. And so almost if there is an accident, almost by definition, it will catch the markets off guard.
Well, maybe the markets know that you and Bob are no longer at the Treasury Department, so we don't have to worry.
Bob, I'd be interested in your view on the debt ceiling dramatics. You saw quite a few of those in your time.
Well, I mean, you should take my views with a grain of salt, because I'm an international guy from the Treasury, but I'm actually more worried about this one. It's coming as the first big test of the Republican majority, the narrow majority in the House, with a very emboldened right wing. I don't know that these folks learned the lesson of past debt ceiling and government shutdown debacles, but that's my worry. I think my hope is that this again goes fairly quietly and easily into history.
Yeah, my take, if I think back to my days on the Hill, these crises are ones that it's just, members can't help themselves. There's always the kind of the jacking and hardline takes until the very last moment where everybody's like, okay, this is really it. The rubber's going to meet the road. But I agree with you, Bob. I think that what we saw in the House and the and leadership elections was unprecedented, obviously. And Kevin McCarthy has an uphill battle to fight with his caucus. And I think it is going to be a long road of him having to do some unbelievable acrobatics. And I hope he's doing some yoga, because he'll need to be very flexible and figure out how he's going to keep his folks, I don't even want to say in line, but in some sort of copacetic arrangement where they can get the really important things done. I mean, I have to imagine that they'll bring in expert after expert to explain to even the hardest of liners in that caucus that this is a bridge too far. We can't let it happen. But I think we will have a lot of dramatic news between now and then. So, okay, guys, maybe that's a good place to end it. John and Brendan, thank you for letting me come back and join you guys today. It's always so much fun. And John, Dick, always so great to have you with us. Thank you. We'll see you next month. And Bob and Matthew, this has been so fun. I hope you all come back soon and we get to talk more about China with you guys. It's been really great. Everyone, thank you for listening and for tuning in. Please subscribe to the Penta podcast channel and tune in next Friday for another episode of the Macrocast.
Thank you for listening to the Macrocast. Please remember to subscribe, rate, and share.